Why do rich people show interest in buying farmhouses? Is there a tax-saving formula hidden behind it? It is Friday evening. The rush of the city has not stopped yet, but some cars are speeding in the opposite direction on the expressway. The people sitting behind the glass do not look tired, but lighter. The destination is a big farmhouse outside the city, where there is greenery, open air, private space, and from the outside it all looks like comfort, peace, and luxury. But this is where the fear begins. Because many times, what looks like a place for a holiday hides a very deep understanding of saving money behind it. And the curiosity is whether some rich people really look at a farmhouse not just as a weekend party spot or a status symbol, but also as a legal route for tax planning. This topic has attracted attention in recent times for another reason as well, because a LinkedIn post by chartered accountant 𝐼𝐻𝐻𝐽 was widely discussed. In that post, she explained that many high net worth individuals do not look at farmhouse and agricultural land only as a lifestyle asset, but also understand them from the perspective of tax rules, capital gains planning, and asset structuring. The central idea of her post was exactly this. If a person believes that a farmhouse is only a leisure property, then he is not seeing the full picture. But here, the very first and most important thing must be made absolutely clear. Farmhouse and agricultural income are not the same thing. Just building a beautiful house on a piece of land does not automatically make income tax zero. Under Indian tax law, agricultural income has its own specific definition. Under Section 21A and Section 10(1) of the Income Tax Act, only that income is considered exempt which is connected to agricultural land and genuine agricultural operations, or in certain defined conditions, is related to a farm building. That means not every farmhouse is a tax-free machine. The real difference depends on what the nature of the land is, what activity is happening on it, what the documentation is, and whether the source of income is actually agricultural or not. This is exactly where ordinary people and financially sophisticated people think differently. An ordinary person often sees a farmhouse as a dream property, land outside the city, family outings every weekend, a little nature, a little status. But a wealthy buyer thinks in many layers. Can this land give appreciation? Is lawful agricultural activity possible on it? Can some income be structured from it? Can it help in future capital gains planning? Should this asset be held on a personal balance sheet or through some entity? For them, a farmhouse is not just land. It can also become a multi-purpose financial instrument. Now the question arises, where exactly is the tax angle? The biggest discussion usually happens around the agricultural income exemption. In India, agricultural income is generally exempt from income tax. Even in the material of the Income Tax Department, it is clear that under Section 10(1), agricultural income is considered exempt. Although in some cases, for rate purposes, it may be considered in the context of partial integration when there is non-agricultural income as well and agricultural income is above a certain limit. The direct meaning of this is that if the income is genuinely qualifying agricultural income, then it does not attract the normal central income tax liability like salary or business income. This is exactly what attracts many wealthy investors. This is where many people make a dangerous oversimplification. They hear that income from farming is tax-free and assume that just buy agricultural land, show some activity, and tax is gone. But the ground reality is not that simple. To prove agricultural income as genuine, land records, crop pattern, produce sale evidence, expenses, cultivation activity, local records, and many times surrounding facts also matter. If some income has been created only by showing farming in name, then the risk of scrutiny remains. That is why there is a very big difference between sensible tax planning and risky tax storytelling. Even so, it would not be wrong to say that, in the legal framework, agriculture has historically received special treatment. In the federal structure of the Constitution, the field of taxation of agricultural income is separate, and central income tax law treats agricultural income as exempt. This is why people who carry out agricultural operations with proper compliance can take the benefit of this exemption. Big investors understand this exact point. They do not just buy property, they buy category. And many times, category is more valuable than the building. The GST angle is also discussed, but clarity is necessary here too. In her post, California 𝐼𝐻𝐻𝐽 mentioned GST benefits from 0 to 5%, and in CBIC circulars too, a framework of concessional or exempt treatment is visible for many segments of agricultural produce. But this does not mean that every farmhouse activity will fall into a low GST zone. GST treatment can depend on the commodity, level of processing, packaging, and nature of supply. There is relief on some agricultural farm produce, and the 2024 circular also gave clarification that large packages fall outside the scope of the 5% levy, but the treatment of processed items and non-agri commercial activities can be different. So here too, classification is more important than the headline. Then comes the capital gains part, where the game becomes even more interesting. Section 54B gives relief to those taxpayers who sell agricultural land and, while fulfilling prescribed conditions, purchase another agricultural land. This exemption is for individuals and HUFs. The sold land should have been used for agricultural purposes, and the timing of purchasing the new agricultural land should be according to the law. If the conditions are fulfilled, then the capital gains tax burden can be reduced or deferred. This is the feature that takes farmland beyond passive landholding and turns it into a tax planning tool. But even about Section 54B, half the truth is the most dangerous thing. This is not some open coupon that will be available on every land sale. This benefit is mainly for individuals and HUFs, not for companies or LLPs. Different explainers and case law references also show that the land should have been used for agricultural purposes, generally in the period before the transfer, and the new investment should happen within the prescribed time. If the money is not used on time, then the capital gains account scheme may come into the picture. That means this route is not as easy as just sold land, saved tax, but is actually a documentation-heavy compliance route. This is where the wealthy mindset again appears different, where a middle-class buyer looks for emotion in property, a rich buyer looks for optionality in property. He likes the fact that a farmhouse can do many things at the same time. It can be a family retreat. It can be a long-term land bank. It can offer the possibility of agricultural income. It can become a future restructuring asset. And if the location is right, then with urban expansion its value can also rise quickly. That means in one single asset, all four layers can come together: lifestyle, privacy, land appreciation, and selective tax efficiency. That is why farmhouse culture has become not just fashion, but financial behavior too. One more thing that is often discussed is the ownership structure. In popular conversations, it is said that very rich people do not hold properties in their personal names, but through companies, trusts, or other legal entities. There can be many reasons behind this approach, such as succession planning, liability ring fencing, governance, control, privacy, or accounting treatment. But it would be wrong to understand this blindly as a tax shortcut. Every structure has a different legal, tax, and regulatory consequence. And moving from personal ownership to entity ownership does not create an automatic tax miracle. Yes, one thing is true. Sophisticated families always look at asset holding in a layered way, not simply as a direct purchase. At this point, many myths are also born. People hear that rich people buy farmhouses and do not pay tax. The truth is a little more complex than this. Rich people often do not try to avoid tax itself, but to change the nature of taxable income. They look for assets, structures, and categories that can reduce the burden while staying within the law. This thinking is difficult for a salary earner because his income is largely fixed and fully visible. But those who have business income, capital assets, land holdings, family offices, or advisory teams can plan the flows of income more strategically. A farmhouse can become one part of that broader planning universe. And this is exactly where middle-class frustration is born. A salaried person cannot escape TDS at all. The moment his salary comes, tax becomes visible. He feels that the system is direct and strict for him, while wealthier individuals have more choices. To some extent, this perception is created because the law contains different heads of income, exemptions, deductions, and asset-specific provisions. But the other side of the story is equally true. Wealthy planning works only when there are proper records, correct use, and professional compliance. Otherwise, the same strategy can also turn into a dispute. The psychological appeal of a farmhouse is also no less powerful. For a rich person, it is not just a tax or land deal, it is also a symbol of control. His own private world outside the limits of the city. No society rules, no parking dispute, no pressure from close neighbors. Open space, privacy, curated experience, fresh produce narrative, luxury entertaining, and a story to tell. When this emotional appeal gets linked with tax efficiency, then a farmhouse becomes an aspirational package. From the outside, it looks like lifestyle. From the inside, it can be structured wealth behavior. But the most responsible conclusion of this whole story is that buying a farmhouse is not a guaranteed shortcut to saving tax. Genuine agriculture will have to be done. The correct classification will have to be understood. State land laws will have to be checked. Ownership restrictions will have to be understood. Proof of income will have to be maintained. And the conditions of every exemption will have to be read. Buying farmland just after watching a social media clip is not financial wisdom. It can also become financial risk. State-specific restrictions on the purchase of agricultural land, zoning issues, conversion risks, title defects, water availability, and usage limitations are also big realities. That is why smart people first buy not the land, but the legal position. CA Minal Goyal's post gained discussion because it highlighted an uncomfortable truth. Wealth is not created only by earning money, it is also created by understanding categories. Those who understand the language of law look at assets differently. In a farmhouse, before they see a pool or a lawn, they see classification. Before a weekend stay, they see future planning. Before open land, they see tax treatment. And perhaps this is why the expansion of farmhouse culture is not just a luxury trend, but also the story of a financial literacy gap. In the end, those same cars on the expressway come to mind again. As they move out of the city, they are not just going toward a party. Many times, they are moving toward that mindset where asset, income, tax, status, and strategy are visible in the same frame. A farmhouse is not bought only because there is greenery there. Many times, it is bought because behind that greenery, a special category of law is hidden. The only difference is that people who see only a house see a building. And those who understand the system see an entire financial architecture behind that same building.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like,
and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.